Good morning, real estate mindset community, and welcome to another morning live. Happy Thursday. We have some absolutely ridiculously insane movements in the market today. We have new record highs as far as this cycle of interest rates. We're starting to kind of, visualize a 9% mortgage rate, 10 years absolutely exploding. We got a lot to cover today. And another thing towards the end of this video, and I'm a little excited about giving you guys this information, but I'm going to show you guys what's going on with asking rents. Asking rents right now are down in some places, entire states, double digits. You guys, asking rent is down double digits in some states right now. So we got a lot of good stuff to cover today. I mean, the high interest rates are absolutely wrecking the market. I think that the market is finally starting to feel those full effects of the quantitative easing. I'm sorry, the quantitative tightening. We already feel the effects of quantitative easing, but the economy is starting to feel the effects of the quantitative tightening and the interest rate hike campaign. So I think that we're starting to see that now. The way I want to start this morning live is by talking about morning cycles, and I also want to compare the 70s and 80s as well as 2008 to the current situation. Now, just to remind you guys, and listen to what I'm saying very carefully, there's basically cycles that are going on right now, okay? And we've talked about this more so last year. Now, I've been listening to some bullish narratives, and honestly, I personally, you guys don't have to, but I choose to listen to the more bullish narratives because I think it's important. If I'm going to review information unbiasedly, it's important to understand what the other side is saying. Now, it's hard to know who to trust because most people are financially biased, but there are some people that I think really feel like the housing market's not going to crash. So a huge narrative that I'm hearing right now that comes with a little bit of validity is the fact that right now the housing market crash is only a transaction crash, which basically means that prices aren't going to crash. So that's a narrative right now. So people are saying right now, prices aren't going to crash, transactions are going to crash, and that's where we're going to stay. And then they compare that to the 1980s, and I'll get there in a minute. But I think what is important to understand is the 4 stages. And you guys may or may not remember this, but remember, stage 1, it all starts with stage 1, interest rates. Okay, so interest rates going up. Now, stage 2 is where we're at. We're kind of stuck right now in stage 2. Stage 2 is sales, which would be sales transaction crash, right? Sales and new construction. So stage 2 is sales and new construction. Now, that is crashing. The interest rates is skyrocketing. Stage 2, we're absolutely crashing. Now, third stage, prices. Fourth stage, inventory. Last year, we were firing on all stages, right? Last year we had price drops and we had inventory growth in the middle of part of last year. Now that reversed. One of the reasons I believe that the prices and inventory stages reversed is because the interest rates were not high enough. The interest rates were not high enough during this year's home buying seasonality trends. Okay, and we also know that because interest rates went down during home buying seasonality, so interest rates did go down this year, which would explain why those last 2 stages reverse. So I think it's interesting to just watch this out. Now, obviously, we have another tier of interest rate hikes. Okay, so the market hasn't even felt 8% yet. So we're going to go into that just like we did last year. But I think it's important to understand, just a general concept of the cycles. Again, interest rates, and then stage 2, sales and new construction, stage 3, prices, stage 4, inventory. Now, let's talk about the 1980s. So, going along this same narrative, okay, a lot of people are saying the reason, if we compare what's going on right now to the 1980s, you'll see that the housing market is going to sustain. And a predominant reason that they say that is, logically, and there's a little bit of validity there, and I had to go back and look at this. From 1970 to 1982, home values went up 150%. That is the trajectory of how home prices went up over the last 2 years, basically. So the fact that they went up 150% in 12 years and sustained the value, it crippled the housing market as far as sales and transactions. So it crippled the housing market from a sales and transaction standpoint. But remember, the prices were normalized and the prices were sustained. So I think it's important to ask ourselves how that happened. I know I did, and I went in deep on the consumer. So I'm going to pull up a chart right now, guys. And the chart is going to show you, and I love, really, this chart is like, If I could just choose one chart to show people the housing market bubble, it would be this chart. I mean, this chart is one of my favorite charts because it also shows us the divergence and the wealth gap happening during the mid 70s. So we're going to look at Case-Shiller home value, and we're going to compare that to CPI, or like what's going on with the consumer. And we're going to really be able to tell a huge distance, a huge divergence in the wage gap. So here's the map right now. Okay, so the red line is essentially home value. Okay, the black line here, could you guys see that black line? Okay, so the black line is CPI. And what I want to do is I want to talk to you guys about the 70s and 80s because that's a huge push right now. Like, oh, the prices are going to be fine because just like the 70s, just like the 80s, it's only going to be a transaction crash. But what I'm trying to explain to people is the consumer is nowhere near the same. It's okay. So if you look at the market and consumers, like the rat race, okay, the rich dad, poor dad rat race. Okay, I'm going to explain this real quick. Okay, so looking at it as the rat race, and if you guys read the book, you understand what I'm saying with the rat race. The 1970s and 1980s, okay, looking at the rat race, when the housing market is a lake, okay, and just say the economy is the bridge. Back in the 70s and 80s, consumers were crossing a bridge made of 2x4s, made of wood. Fast forward to today, the consumers are walking over tissue paper. That is the strength of the consumer rate, and they're walking over tissue paper. Anyways, let me go back into this. I'm going to show you what I'm talking about. Oh, and another thing, you guys, I looked at what y'all know what the 10-year was back in the 1980s. 14, it got up to 14%. Y'all, we could buy 1 month treasuries or 1 year treasuries at 14%. We can't do that right now. But anyways, so I want to show you guys basically the gap. Okay, so the gap that I want you guys to pay attention to is basically the gap between the red line and the black line. And if you guys look at starting around 1976, 1977, that wage gap started separating. House values became unhinged. But look at, okay, you guys can kind of see that gap right above my arrow. The gap is not even that big. So even though during the 70s and 80s, home values went up 150%, consumers still had wage growth of almost double digits. For what, 15 years, wage growth was at least 7% for 15 years. Plus, they had the ability to save so much more money. The savings rates back then was 11% of household income. So they had the ability to save, plus they can get 14% back on their money. So when we look at the PE ratio, the price to earning ratio, it's nowhere near the same. Houses are so toxically overvalued right now. You see that in the gap, but nevertheless, the primary reason home values sustained during that period of time, in my opinion, was because the consumer, the American consumer, was strong. Fact, they were strong. This is what we're talking about our parents, talking about our grandparents. They were way stronger than what it is today. And that's a fact, you guys. And look at, when we compare the 2008 run up, okay, that's this bubble. And again, started becoming unhinged around around 2000s, early 2000. Become unhinged. Okay, lack of fundamentals. Okay, all this lack of fundamentals right here. Look at that. Look at that gap right there. That's a huge gap. You see that? That's a 2008 gap. And look at prices. I'm talking prices, not transactions, declined. And look at the gap. They lowered that gap right there. Okay, so that was the trough right there. See how close that black line and that red line are? Now, when we move forward, look at this, guys. Look at the gap now. So for people that are saying there's no bubble that exists, it's just, how could anyone logically say whether, and again, I'm not talking about whether they believe prices will crash. We're simply saying it's a bubble. This is a massive, massive asset bubble. So I really love this chart, guys. This is a really easy way to kind of, combat a lot of these hawkish narratives, because this really, in my opinion, paints the picture of the consumer and the health of the housing market. And right now it's just so unhinged, you guys. It's so unhinged. In fact, right before the recession and lockdowns, the housing market was all messed up. I don't know if you guys remember that, but back at the end of 2019, I remember thinking to myself, dang, the housing market's slowing down. And then boom, COVID, everyone forgot that. And look at this, boom, massive run up in equity. And this is what I'm saying, you guys. And just because we're stuck right now, we're stuck on stage 2, doesn't mean that things are going to stop. Oh my gosh. Hey, Dan, I see Dan. Where's Dan at? Where's Dan? Dude, you got to be careful what you say, dude, on your channel, man. The CFPB will shut you down, brother. You can't say, Dan, you can't say that rent's going to go up 15% and just buy and go apply for your loan application. You can't do that, dude. That is a CFPB violation. Dan, why are you here? You hate what I'm saying. Brother, please kick rocks, Dan. I thought you said this the last time you're going to comment on my channel. What's this dude? Sometimes I think we should start reporting these YouTubers literally to the CFPB because these guys are doing nothing but making the problem worse, at least in my opinion. All right, so let's move on to the next thing, guys. Let's see what's happening in the market. Okay. Now, the 10-year is absolutely exploding right now. So the first thing I wanted to show you is what's going on in the market. So the first thing is higher rates for longer because it appears that the labor market is still super tight. Now, I understand that the job numbers, you guys, are a little bit hollow, and most of the full-time jobs, as far as new jobs, okay, and as far as job growth, most of the growth is in part-time jobs. Nevertheless, even though it's weak, even though the labor market's weak, what I want to explain is people can still get a job. Even if it's a part-time job, it's still a way to get money. And one of the big things that I keep trying to, explain to you guys, something that happened during the great financial collapse. And I think this is really the difference between me and the bulls, the unhinged unemployment. If unemployment becomes unhinged, people can't make their mortgage payments, you guys. So the fact that you could still get like 2 part-time jobs means people can still make their payments. People can still pay their bills. So, on one hand, it's crappy jobs, but what that means is once unemployment does become unhinged, it's just going to be more out of control. And unfortunately, maybe so out of control where there's going to be bank bailouts. But anyways, guys, jobless claims fell to a 9-month low of 198,000. Okay. Now let's see what's going on with the 10-year. And I'm going to show you another reason why this 10-year right now is absolutely blowing up. So you guys may remember, oh my gosh, look at job cuts. So we got job cuts, Tesla sell off. Oh my, so Tesla's not doing good. But you guys, the 10-year is at 4.93. It's up 3 basis points and it got up all the way to 4.9, was it 4.98? Almost 4.981. You guys, this is so, I can't believe this sucker might hit 5% in October. Now, you guys remember me saying during my last podcast that I knew that interest rates were going to go higher, at least a new record for this cycle, and that's exactly what happened. Now, we're tracking this 10-year because this 10-year is absolutely murdering the economy, is absolutely murdering the corporate market, business market right now, okay? So the 10-year still going up, and I'm going to show you guys how much China and Japan has been selling, especially so the interesting thing is Japan is, okay, so the world is partially responsible for this. I don't know if you guys knew that. Japan has been selling so much of the 10-year, it's insane. And what happens when people sell the 10-year? Remember, guys, when people sell the 10-year, it goes up. When people buy the 10-year, the rate goes down. Remember that. It's the reverse. It's very interesting when you think about it. But nevertheless, you guys, the 10-year is blowing up, which means what's going to happen to interest rates today? It's going to be over 8% today. All right, now take a look at the short end of the yield. Okay, so here's the short here. All right, so here's the 1 month, you guys. So the 1 month is sitting at 5.411. Now, the interesting thing is this was actually down right at market open. So what I notice is sometimes when the 10-year skyrockets, the 1 month actually goes down. And it's because people are more than likely selling the 10-year, are getting out of the 10-year and going into the shorter end of the yield, which is the 1 month. And this is what I buy, you guys. So I would say probably 90% of my liquidity is in the 1 month treasury. It's just a good way to get extra money to help offset the inflation. Now, remember, you guys, back in the 1970s, 1980s, this got up to 14%. I'm sorry, the 1 year got up to 14%. So people could save almost at triple the rate that people could save now. And the PE ratio was lower. Okay, the price to earning ratios was lower. So their money was more valuable back in the 80s is what I'm trying to say. But anyways, guys, let's see what effect this is having, the skyrocketing 10-year. Let's see what it's having on the inversion. Okay, so here's the inversion right here. This is the 10-year and this is the 2-year inversion chart. This is this is what so many of these bulls can't understand and they just can't fathom it. And the reason they can't fathom it is they're so stuck on lead generation. A lot of them are stuck on lead generation, are absolute clowns, and we kind of see that now. But regardless, you guys, this is a huge warning. We've been talking about this the whole time. The bulls are saying ignore history. The bulls are saying risk on. It doesn't matter to them. It doesn't matter because it's your money. It's your risk. They will never talk with caution because they're paid to do the opposite. And it doesn't matter how many times they go to church. It doesn't matter how good a person they think they are. They're leading people into a very toxic and risky direction. They're being foolishly optimistic. We see it, you guys, but look at the freaking inversion. You guys, skyrocketing again. Now, obviously, we were skyrocketing, towards the middle of September, skyrocketing, obviously a 10-year, right? 10-year shooting up. We're actually re-inverting because of the long end of the yields. But look at this, guys. Israel went to war. Okay, this dropped. It got inverted a little bit more because that 10-year dropped. But look at, just like that, it's at a new high. You guys, the last time, let me see here, the last time the 10-year was this high, I think it was in the, actually, I didn't write that down. I'm so sorry. But anyways, guys, the reinversion, 28 basis points. Generally, when we're uninverted, that means the recession is right around the corner. So if this uninverts, expect the recession to come at any second. However, it doesn't always reinvert. Okay, remember when I maxed this graph at, it did not reinvert over here during the 70s and 80s reflationary battles. So in other words, guys, what I'm trying to say is this is a new rule book. Things are really, really crazy right now because this has never happened before. Now, let's take a look at what effect this is having on the overnight reverse repo. Now, look at this, you guys. Unfortunately, that went up. This is day over day. Why did this go up? Well, one of the reasons why it went up is because this 1-month treasury right here was at, let's see, about 5.375. So this was still above the overnight award rate, which is 5.3. But anyways, guys, the more that you see that 1 month right here, the more that you see this 1 month higher than the award rate for overnight facility, the faster that this liquidity is going to drain out of the economy. So this is like the excess money printing. Okay, so if you want to know, like, what are we looking at here? This is like when this is gone, the money is almost gone, right? Like the COVID money is gone. And now like things are going to fall apart, which is also brings me to the next thing, you guys. People say how strong the economy is. People say how strong the consumer is. There's credit tightening on the way. But you guys, without what you're looking at right in front of you right here, the economy would fall apart. You take this away, you take this money away, and all that money printing, this is the excess money printing, the economy is gone. This is a lifeline right now. We're learning a lot about this, but regardless, you guys, depending on what happens with that 1 month, so if this kind of stays sideways, it will probably have people still selling on the overnight, but keep watching that. Very, very interesting. Again, you guys, when we're talking about the short term, it's more of a liquidity zapper because people are buying the short end, right? The 1 month, the 6 month, and things like that. And then the longer end is what's killing the economy, banks, mortgages, and things of that nature. Now, remember, the 10-year tracks mortgage rates. So take a look at mortgage rates, you guys. So mortgage rates right now, updated. You guys remember? You guys remember me saying this? Look at, we finally have hit 8%. Now, I also want to explain to you guys that when we're looking at Mortgage News Daily, okay? Mortgage News Daily is going to be probably a little bit more prime average or like good credit people average with a higher down payment. But you guys, we finally hit 8%. This is a record high for me being in the business for 22 years. I have personally never seen the average interest rate this high. In fact, the last time interest rates were this high, I was still in high school. The last time interest rates were this high was August of 2000. We have a 23-year high right now. 23-year high right now in interest rates. It's very interesting to see the lag effects take into effect here. But let's really dig in and see how expensive 8% really is. But first, let me show you Google. Now, I want to explain to you guys, some people really look at this. Okay, this is Google interest rates. So when you guys see people, talking about interest rates and they're higher than what I'm saying, understand the reason that is because they're using someone else. They're using Google, and Google is showing interest rates at 8.3. Now, the reason I think that is probably accounting for everyone, right? Whereas Mortgage News Daily is more of a prime, more high down payment, high FICO score. So the reason I'm telling you that is realistically, the interest rates are going to be between what Mortgage News Daily is saying and what Google is saying. So more than likely right now, people are probably getting on average like 8.3, right? Because if we take the middle of 8.6 and Mortgage News Daily right here, which is 8%, people are probably getting 8.3 right now. So very, very interesting. But let's look at the amortization schedule, okay? 8%, 8% interest is so bad. This is an amortization schedule. One of the worst types of debt you can get in is a 30-year mortgage. At least it's fixed and not adjustable like foreign countries. Holy smokes. But anyways, Horrible, horrible debt, you guys. Real interest rate on 8% is more like 160% over the life of the loan. And let me show you the loan amount. Sorry, guys. Here's the loan amount, $328,000. So the loan amount is $328,000. You pay 8% on that. You pay back in just fees, $538,000. And that's why we need to start reporting these companies to the CFPB. I'm telling you, these guys are lying through their teeth. We need to start reporting. They're lying through their teeth, you guys. They're lying through their teeth. Anyways, $538,000. Now, the thing is, guys, is that may go up if you refinance. Think about it. If you refinance in 5 years, you have to pay all these fees over again. So anyways, let's take a look at what it would take to pay down the amortization schedule 5 years. Okay, so we start at $20,000. Today at 8%, it takes $16,171. That is it. Only $16,000 to pay down 5 years of your amortization schedule. Now you save so much money. We know this because it's front loaded with interest. It's front loaded with interest. So you pay $16,000, you guys, you save. You want to know how much you save? You save 5 years and in interest, $128,000 unless you refinance. If you refinance, you start this all over again unless you refinance into a loan that has a shorter amortization, right? So if you pay this down to 25 years and you refinance into a 15-year loan, then that's okay. But anytime you extend instead of reduce the amortization schedule, y'all pay so much more than you realize. It's so much more, you guys. And that's what and people are really stuck on payment, and I understand payment's important, but you have to understand that price is also, and I would say way more important. I would say price is way more important than payment. Anyways, let's look at how much people can afford right now, okay? So here's how much the average family that's making $100,000 can afford, okay? So we're gonna say $100,000 family, interest rate 8%, 18% down payment, average down payment, $1,400 a monthly debt, 45% debt to income ratio. That's gonna put the new purchasing power at only $287,000 if you put down, look at that, $60,000. People are like worried about the payment. What about the out-of-pocket expense? What if you lost the equity and lost all your $60,000? How would that feel if you had to sell? That's not going to feel good if you have to sell. But anyways, guys, $287,000 if you have $60,000. Now, when we remove the debt, like credit card debt, when we remove that, okay, and we recalculate this, we go from 287 to 462,000. But because the amount is higher, your down payment is also higher. You see that? So the down payment is higher. So you can afford now $462,000 if you have $97,000 down. But regardless, what I'm trying to tell you is by me taking out that monthly debt, a consumer can get an additional 60% in purchasing power. The difference in purchasing power is $174,000. So in other words, what I'm trying to say is consumer debt. You guys, consumer debt absolutely destroys people's purchasing power. And it's just really a prison. It's really, I just can't put that into words enough. Now, here's the thing, you guys. We're going to go into our first video. I like this video. The bulls are getting crushed. I mean, look at Dan Frio. He jumped back on my channel. That dude has been harassing me, you guys. Why did he join right now? He's joined because he's got nothing better to do. He's got no business. Dan, beat it, dude. I'm not even joking, guy. I'll show you how to report people to the CFPB for violating consumers and basically being dishonest. You can't be dishonest. If you are a lender, there's so much rules when it comes to lending and the things that these people are saying. It's just, it really makes my skin crawl, you guys. I'll make them a special project. I will. But anyways, we're going to go into this video. Now, this video is insane. Okay, so this video is basically a call for help. They're basically saying the government needs to help. They're starting to see that home affordability is out of control, and home affordability may continue to get worse until prices and rates come down, and rates aren't going to come down until something breaks. Let's be honest about that. So anyways, you guys, I hope you like this video. This is a really good video. I hope you guys enjoy. If you can, Johnny, and let me know that the audio is okay.
Graham as well now. He's from Mortgage News Daily and MBS Live. And he says it's no longer just about the Fed here, everybody, for mortgage rates. They are at the whim of other numbers and events as well. Let's bring him in. Matthew, it's great to have you on the program. Welcome.
Thanks. Great to be here, Kelly.
And we should emphasize this is always true. Mortgage rates don't price off of the Fed funds rate. They price off of the 10-year, which is affected by tons of other global events and things going on, but especially so right now, right?
Yeah, and just a minor point of order, they don't necessarily price off the 10-year. They correlate highly with the 10-year over time, but they actually price off mortgage-backed securities, which are very closely related to the 10-year in general, but have some distinct differences since the Fed started not buying bonds.
Let's get real wonky, shall we? What other chance would I have than talking to you and Diana? Because now there's, kind of efforts making the rounds to say maybe Fannie and Freddie need to do something here to bring down the cost of mortgage rates in particular. What can be done by the marketplace to try and cushion what otherwise has been a mortgage rate that's highly tethered to what's happening with bond yields?
Yeah, and this is a frustrating thing, and my audience specifically isn't going to like to hear what I have to say about this, but nothing's going to be done at any official level to try to ease the pain of rates. The housing market has been central to the inflation problem that we have. You know, we can talk about affordability being rough for new buyers, and that's very true, and that's a pain point. But at the same time, we have to consider what happened in 2020 through the middle of 2022 when people were able to refinance at 2.5%, 3% rates and free up a ton of cash flow that has subsequently driven inflation. And that has resulted in a crankier Federal Reserve and rates moving higher. So I don't think you're going to see a lot of love from an official level, whether that's from Fannie, Freddie, or the Fed itself.
Diana, do you agree? Because it would seem that, housing is always the one place where officials really want to come in to the rescue. And we've seen tons of efforts over the last couple of decades. Some work out well, some backfire, to try to improve affordability. And affordability is worse now than it's ever been.
Right. And I'll tell you, I get dozens of emails in my inbox every day from various, organizations saying the government has to do something. We have to get affordability back. You have all of the associations. I don't have to tell you how much the realtors are getting hammered by this and how, real estate agents are kind of fleeing their jobs right now because they have nothing to sell. But I think Mac makes a great point, and that is that so much of inflation right now was driven by housing. We're seeing it's still in the rents, even though rents are coming down a bit. But in home prices, up 40%. That is astonishing in just 3 years. And so I agree that I don't think anybody at a government level is going to do anything to bring back those rates to a point where, home prices can just climb higher and higher. The question is, what can you do on the lower down payment, on the FHA side, on perhaps some kind of programs to help people afford housing without bringing rates down to these abnormally low levels? 2.75 is really just going to create a market that's going to be on fire. You're never going to be able to put that out, Kelly.
And the argument is from Dave Stevens. He was kind of briefly Obama's FHA commissioner. And he says that Fannie and Freddie should return to the MBS market, Matthew, and that, listen, we're going into an election year. And maybe somebody's going to look at this and say, yeah, maybe they should, because the spread between mortgage rates and I'll say the 10-year, but it's wider than it has historically been. And the Fed doesn't look like it's coming back into the market anytime soon.
Yeah, it's not coming back to the market because it realizes that it maybe accidentally, maybe unavoidably played a role in driving inflation by keeping its foot on the accelerator in 2021 with MBS purchases. So I think that they're seeing, even recent Fed comments have said, yeah, the housing market is doing kind of what we want it to do. And that's unfortunate for people.
The Fed might say that, and the Fed can say that and try to understand the macro effect. But you don't think the political side of this in Washington with the housing market into the election year, someone might not say, you know what, Fannie and Freddie, you go buy MBS then and bring that rate down?
Well, I think Diana nailed that point, and there can be a push for initiatives that help affordability without trying to manipulate the broader financial market. And that's really the ill effect of fiscal stimulus and especially relentless QE in 2021. So that's right on. We have to, if we're going to help affordability, it has to be at a fiscal level.
Yeah, and maybe at a...
Okay, guys. So, okay. So he's acknowledging, right? He kind of acknowledged that we're kind of in this situation because of the low rates, right? The money printing. And yet their solution is for Fannie and Freddie to buy mortgage-backed securities to subsidize the mortgage market and help keep interest rates low, when that's exactly why we're in this reason to begin with. Think about what these people are saying. So they didn't touch on price. They didn't touch on just, let's just stay elevated, because the longer we're elevated, the more likely the pressure will be put on prices of houses, and those will go down. Why will it go down? Even though there's limited supply, because there's a lack of sustainable fundamentals in prices. And anyone could tell you that. The difference is like some people have a justifiable reason, or a reason they can explain on why it won't happen. And some people are on the other side of the coin. But what we don't like is the cheerleaders that absolutely know nothing, you guys. So, do you really blame consumers? I mean, how much can we really blame consumers? But anyways, the fact is when I listen to that video, people are starting to accept the fact that we're going to have higher interest rates for longer, and that the pain of unaffordability is going to be here a lot longer. So I would say that, hopefully the people that are, purchased properties during 2023 had realistic expectations. If people had realistic expectations, maybe they'll be okay. But the thing is, guys, is I'm pretty sure that people did not have realistic expectations, and they are basically in a world of trouble. Now, what I want to talk to you guys about is like, okay, why is the 10-year skyrocketing? And like, why couldn't it have kept skyrocketing at the beginning of this year and maybe avoided, 2 million people purchasing overpriced houses? So one of the things that I want to explain to you guys is how outside forces can actually manipulate the 10-year. Specifically, and I want to go into this article and I'll show you guys, specifically China and Japan, you guys. Especially Japan is selling so many 10-year treasuries right now. It's adding to like a faster increase of rate. It's really, really crazy. But I wanted to just briefly touch on this. China and Japan's share of U.S. bond market shrinks to record low. Again, when they sell, rate goes up. When they buy, rate goes down. So take a look at some of this, guys. Pretty interesting stuff here. Okay, so what if Japan and China intervened in the foreign exchange market to sell dollars and support their currencies and liquidated U.S. treasuries in the process, and the sky didn't fall down? So a lot of people didn't see this coming a few years ago, but let's read on. It would be a scenario hard to imagine 10 years ago, but it's more plausible now because the world's top two holders of U.S. debt no longer pack the treasury market punch they once did, either inadvertently or even together. So they had a huge stake in the treasuries, but now, you guys, that's starting to go away. It's very interesting. So again, the 10-year may explode even more. The 10-year may go out of control unless the government intervenes and starts buying it, because that would drive it down. But then again, if they start selling it, like they're supposed to sell mortgage-backed securities, could go up. So very interesting. A lot of dynamics here. The Japanese and Chinese central banks' combined footprint in the world's largest, deepest, and most liquid government bond market is now its lowest on record, at least since comparable data began collecting in the late 1990s. So look at this chart. Let me read this last little part. Japan's official stash is 1.1 trillion. That represents 4.4%. I didn't know that they had such a huge stake of treasuries, you guys. Can you believe that? Japan has 4.4% of the market, and that's a record low. That's a record low, and they have that's a lot to me. Now, China has 835 billion, and that's 3.5% of the total. And that's the lowest level in 20 years. So we gave these foreign governments a lot of power over the treasury market, the debt market. Now, look at this, guys. Here's the chart. Okay, here's the chart outstanding. So this is China and Japan official holdings of U.S. treasuries. It's important because interest rates track the 10-year and obviously mortgage-backed securities. But look at this. Here's what I wanted to say back during the Great Financial Crisis. Okay, when I say that the world bailed us out, look at the holdings during the Great Financial Crisis. Way up here. Was that 2.2 trillion? So dude, I'm trying to tell you guys, the world helped bail us out during the Great Financial Crisis, and they are not able to do that today because they themselves are in a worse situation than the Great Financial Crisis. China's in a worse situation. Canada, UK, everyone's in a worse situation than even the Great Financial Crisis, including the US, in my opinion. But look at this. It's plummeted. They are selling treasuries like crazy, you guys. So I just wanted to let you guys know, that's another reason why we're seeing that 10-year skyrocketed. There's a number of reasons that that's happening. And it's very intriguing, guys, because it's out of some of it is out of our control. And that's when, when things become unhinged, that's when like real bad stuff happens. And that's what I'm starting to see personally. Now we're going to look at our second video. Our second video is going to go into you guys, the housing market's so unaffordable right now. The second video is going to go into the unaffordability. And these people are basically saying The bigger impact on unaffordability is not interest rates. The bigger impact on unaffordability for homeowners is property taxes and insurance. Think about what I just said. If that's true, what does that mean, guys? Right? The fundamentals aren't there. People are thinking the housing market is going to sustain, but people lack the understanding that the consumer can't sustain it. We're not going to be able to, even with loan modifications, if someone loses their job, they don't qualify for a loan modification. So there's a lot of stuff going on here. Let me know what you guys think about this. Again, this is going to go into property taxes and home insurance being a more effective unaffordability gauge.
But said loan growth continues to moderate as, you guessed it, higher rates and insurance costs change consumer behavior. The company sees headwinds to future loan growth as well. Joining us now with more on the business is John Hairston, president and CEO of Hancock Whitney. John, it's great to have you here. I don't think you've been on before with us. Welcome.
No, first time on the show. Thanks for including me.
Down in the Gulf, as I understand it, Mississippi area and so forth. And we were hoping maybe you guys have a different and better read on the economy, and maybe a stronger one, but it sounds like you are experiencing some slowdown trends.
Well, it depends on which part of the footprint. I'm actually in San Antonio today. We open up our first San Antonio office, do the ribbon cutting this afternoon, in fact. So many of the markets across our footprint actually have been quite well and good for growth. The slower parts of our market typically have very low pressure during downtime. So it's a healthy balance of high growth markets and stable markets.
How long have you been in the business? Because this is a question I feel like is becoming more relevant than ever. Those who have lived through a couple of cycles with high interest rates arguably are going to have better institutional memory than those that haven't. So how do you compare banking in these times with what you've previously been through or not been through?
You know, it's a great point. When we look at the ages of bankers and credit people across the industry, it's shocking sometimes to realize how many of the gray hairs left during the pandemic. So I've been in the business for over 30 years. I've been at this company 29. So no stranger in the management team and boards, no stranger to cycles. This is just another cycle.
The main concern, I mean, there are many. We'll talk, commercial real estate exposure. You guys think it's pretty limited. I was struck by the fact that Goldman CFO the other day on the call said they've impaired their CRE exposure by, 50%. So just being extremely conservative. Is that your experience as well?
No, we've actually had pretty good luck with CRE so far. And by CRE, I'm referring to investor commercial real estate. And I think some of the comments you hear from other players are due to urban concentration in towers where there has been understandably a lot more pressure due to the lesser number of people working in those buildings. Our footprint, while we do have some urban areas, we really aren't much of an office tower lender at all. We have less than one hand of projects on our books, all of which are extremely low LTC.
That's really interesting. So let's talk about the impact higher yields have had. I don't know if you found yourselves in the same kind of awkward duration position as some of your peers, or how you made those decisions at the time about what to do with your deposit explosion if you were among the many banks that had one. What's the status today?
Well, that's a great question. Back when the pandemic was in its go-go days and the government was putting a ton of money in, we were a PPP lender supporting our business clients and clients of other banks that opted out of that program. So we did see a huge inflow of deposits, but we really are a conventional bank. The company celebrated its 124th anniversary last week, so we probably got more than our fair share of deposit inflows. And at one point in time, the free money component of our deposit book was actually 50%.
Wow.
50% of all of our deposits were in checking accounts. So those are real clients. So this third quarter, as we've seen the deposit cost increase and mitigate a bit, we actually saw a pretty big reduction in compression in our margin. So I think we're beginning to see the coming out, the wrong word of getting better. We're beginning to see NIM compression ease. So the beginning signs of NIM stabilization.
What's the impact on the consumer, on some of the commercial business from higher rates? I have a hard time imagining that people can really handle 9 or 10% borrowing rates, whatever that figure is, that would kind of help with your net interest margins going forward. I mean, it seems difficult.
Well, certainly we've seen a dramatic downturn in the amount of big ticket purchases occurring. We don't see nearly as many people doing large purchases like they did back in the days where average account balances were so high. A lot of that excess liquidity has already flown out of the market. And in reality, we see the summer of 24 is when deposit average account size balances begin to move towards pre-pandemic normal. So we're probably at the late third quarter of the game in terms of getting people back to a normal spending habit. But I will say this, Kelly, and I know you mentioned this on one of your shows prior, the bigger pressure on consumers are really more housing. Housing costs have gone up tremendously. And there's a lack of affordable housing in the country that makes it difficult for people in the hourly positions to house their families. So I don't think interest rates are as big a strain on the consumer right now as the cost of housing and insurance.
Okie dokie then. Well, I mean, if he's right, that just shows the lack of sustainability. All right, now again, you guys sit tight because we're gonna go. I got to show you the asking rent. I got to show you guys the asking rent data. When I saw the asking rent data this morning, it was like a huge slap in my face. I'm telling you guys, the rental market right now, historical stuff happening in the rental market. Now, real quick, Straight Drive. I threw up Straight Drive's comment because I wanted to warn you guys, like, don't argue with Straight Drive. I can't even respond to your comments anymore because Straight Drive has like 8 accounts. He talks to himself. He likes his own comments, laughs at his own jokes. Straight Drive, if you're so confident about the housing market not crashing, why do you have 8 accounts and why are you liking your own comments and making conversations up with yourself? Why? That's weird, man. Stop doing it. It's weird. I mean, you can still do it. Now, the reason I like keeping Straight Drive around is I want him to say sorry when everything changes. And also, there's still Straight Drive, stick to your good points, man. I think you're a smart person, but dude, stop wasting time trolling unless you're in high school. My God, man, if you're a grown man, what's wrong with you, brother? How many accounts do you have? Comment below. Let me know how many troll accounts that you have. Seriously, this guy tops Johnny. This guy tops Straight Drive. You know who Straight Drive probably really is? Dan. I bet you Straight Drive's really Dan Frio. Dan, bro, enough, bro. Just do you, dude. Just do you. Stay in your lane, bro. Anyways, guys, let's look at this next article. I like this article. All right, hold on 1 minute. Let me change it like this. Now, according to Bloomberg, here's what 8% mortgage rates will do to the housing market. And this just came out, you guys, this morning, right before the live at 3 a.m. How do you like that? All right, so we're just going to sum up a few things here. Boom. Okay, so they're basically listing a few things that they believe. Again, this is them. This is not me, but they're listing 5 things that they think is going to happen with interest rates at 8%. Now, the first thing is the impact of higher rates has been slow. And also, you guys, it has been slow and it actually has reversed. And again, remember what happened this year. Their interest rates reversed this year. We were making great progress, great trajectory, and then boom, someone threw a wrench in the Federal Reserve's plan. That's called bank runs. Those bank runs, holy smokes. But anyways, you guys, so they think it's going to be a slow impact, even though the housing market right now is completely gutted. Now, the second thing is, and this is a good one, deteriorating affordability means lower demand. And this is what I'm constantly telling you guys, even if we have okay, so one of the other things is what has to do with demand. Okay, sentiment has emotion, especially in the housing market, has to do with demand. And I think on top of the quantitative easing this year, the sentiment changed. I think the sentiment changed and people thought, you know what, the Fed's got us, interest rates are going to go down. And they just started buying into the narratives of these bullish people, these crazy buying incentives. But regardless, you guys, it's bad. Unaffordability is going to be the leading cause of what's going on in the housing market. Unaffordability. I mean, it's really, really easy to see that. And you guys can see the year-over-year change in affordability. Look at that. You guys see that? Okay. It's a little bit small, but the unaffordability is just, it's going to get worse. In other words, it's going to get worse, you guys. Now, number 3, but higher rates could also mean tighter supply. I like talking about this. This is what people call the golden handcuffs effect. And it has had an effect on existing listings. That's a fact. But the reason why I think this is so intriguing is I think about 6 months ago, some bull was like, oh, if rates go down to 5%, we'll have double the inventory. And I'm like, y'all are freaking out of your mind. If they go down to 5% right now, we're dead. Like they can't go like eventually, yes, but not right now. But, I did a Zillow video, you guys. I think there's anywhere from 600,000 to 1 million listings on the sideline that would sell their house. I think, again, 600,000 to 1 million people would sell their houses if rates were in the low 6s. I really think that. So that's very interesting. So when does that happen? That's never happened before. That's very, very interesting. And especially it's very, very interesting because the prices are so heavily dependent on the lack of supply. And demand being more than the lack of supply. So the lack of demand is still higher than the lack of supply. Pretty much because of sentiment. It had nothing to do with fundamentals. Now, here's number 4. Okay. Tightness in the U.S. housing market means consumers may treat their homes differently than before. This is stupid. I don't know where, this is completely ridiculous. Okay, this is what this is. However, in 2023, with house prices still close to all-time highs and the cost of rent surging, there are signs that Americans are more dedicated to preserving the equity in their home. So basically, they're saying is people have equity today. Back in the day, people didn't have equity, even though that's not true. People had equity during the Great Financial Collapse. The reason why people lost their houses is unhinged unemployment. I keep telling people, like, I understand the narratives of the bulls, but I would ask them, do they understand what we're saying? I perfectly understand their point. I just don't think they understand what we're saying, or at least what I'm saying. Now, here's number 5. So it all comes down to supply if it was in a vacuum, right? So a couple things here, you guys. This little theory here I thought was very interesting. In theory, a recession that comes, again, in theory, according to the article, a recession that comes with a substantial job loss could create what? More forced selling. And that's what happened during the Great Financial Crisis. But this goes on. But even there, the effort is ambiguous. That's because in the aftermath of the Great Financial Crisis, as home prices plunged and defaults of home loans surged, a whole infrastructure for mortgage modifications was put in place in order to prevent foreclosures. Okay, so in other words, what this is saying is we're in a lot better position to handle an economy and a housing market that has a foreclosure crisis. But I also, and I agree with that, the loan modifications are incredibly effective, whereas back during the Great Financial Crisis, they were just started. So people didn't know what the hell they were doing. Literally, like banks didn't know what the hell they were doing. Fast forward today, they know. But here's the thing, you guys. As more and more bank runs, or let's just say banks get bought up and we continue to go through this credit tightening, the more unhealthy that these lenders get and they're not receiving money from these assets, the less likely they're going to be to modify. And the more likely they'll do probably to foreclose your ass. Excuse my language. Oh my God, I can't believe I said that. Foreclose your butt. And they may just, instead of doing a loan modification, here's $10,000, give us your keys. Here's 10,000, here's 20,000, here's 15,000, give us your keys. May happen. We don't know what's going to happen because they're okay right now. We're going to go into our third video, you guys, right now. Can't believe I said that. I'm so sorry. I'm really good at that stuff too. Housing starts. All right, so we're going to go into housing starts right now. Housing starts came out. In a few more days, I'll have all of the new home data. I love watching new home data so much because there's so much inventory. There's literally not a lack of inventory for new homes. There's a lack of affordable inventory. There's a lack of affordable inventory. But anyways, enjoy the video. Whoops.
Rick will probably talk about. The 10-year is at 4.84%. Rick Santelli, you got some numbers in Chicago for us. What are they?
Yes, housing starts, Joe. These are for the month of September. And we all know interest rates have been hurting housing. 1,358,000, 1,358,000. That's the best, well, just since July, because last month, 1,283,000. That was the worst level going all the way back to June of 2020. I haven't seen a revision yet. So we're basically up in the vicinity of 7% on housing starts for September. And if you look at the permit side, which has been running a bit stronger, as we need, of course, new houses, and we also need interest rates to be more affordable so people can afford them. Building permits, 1,473,000. That is definitely a smidge better than we were expecting. But in the rearview mirror, we have a revision that was already established at 1,541,000, which, by the way, in complete contrast to starts, was actually the best since October of 22. So that is a deterioration of a little over 4%. Now, if you looked at the MBA survey this morning, they claim that the 30-year fixed mortgage is 770. Bank rate yesterday had it at 789. So as we get closer to 8%, it's obvious that the dynamics are working against housing. Another issue, if you're paying attention to interest rates, everything but the very longest maturities yesterday made a new post-COVID cycle high yield close. The previous for a 2-year note had been 518. Obviously, we closed higher. We're now at 519. We're down a couple of basis points, and that level was 481 for 10s, currently trading at 483. That's down 1. 30-year bonds did not. They needed to close 498 or higher yesterday. They failed to do so, but we're really splitting hairs here. Many looked at retail sales yesterday, Joe, and said, okay, that's better than expected. I don't know. Bam, is Emerald in the kitchen? These numbers sometimes to me don't add up. But we did see yields move a bit higher, especially short maturities yesterday, because maybe that brings the Fed a little warmer. But for the most part, many think that the recent jump in interest rates has more to do with debt deficits and maybe what lies ahead with regard to Japanese monetary policy. One quick note, if you look at housing starts now, and you consider that in May of 2018, the high water mark for 11 years was 1,357,000, which stood until December 2019. My point here is slippery and downtrodden as starts are, they sort of kind of fit into what we were looking at pre-COVID outside of the very last month of 2019 and obviously what happened in 2020.
All righty then. These new home builders, you guys are in deep trouble. I don't care what they're saying. I know it's going down. It should go down because it's so excessive right now. And I know we need more building, but you guys, we haven't had like the event happen yet. There's going to be an event. Okay. Again, as long as the Federal Reserve, oh my gosh, I just looked at Netflix. Netflix surges. Totally lost my train of thought. Netflix just hit me right in my soul. I can't believe it's up so much. Anyways, you guys, let me move on to the next thing. This next thing is really, really big deal. But I was going to say that, I mean, builders are still building. They still have an overwhelming amount of inventory. They are insane. Buying incentives are no longer working. So what I want to do now is I want to show you guys the data that I reviewed last night, and it was really shocking to me. It was really shocking. It's a little bit lagging, but it has to do with the rental market. The rental market is... The thing is, guys, if the rental market goes down, it is going to create some really massive problems for institutional investors, for real estate investment trust, for the long-term rental market. The short-term rental market's already getting crushed in the areas that are banning STRs. But the rental market is huge. And what I want you guys to understand is we, for probably the next 2 or 3 years, are going to have a massive, unprecedented increase of inventory and supply in the rental market, at least the next 3 years. Massive increase, unprecedented amount of supply coming to the rental market. So naturally, we have things set up now in the long-term rental market to continue to put pressure on prices going down, not to mention the unaffordability, right? We have the unaffordability, but the supply is really helping us here. And take a look at the top 10 states of decline. Huge eye-opener for me, Let me see if I can zoom in this. This is asking rent. So again, this is lagging. It needs to go into rent. This is just asking rent. But take a look at the freaking losses in asking rent. This is a huge shocker to me. Slap in the face. The rental market is actually deteriorating faster than I first realized. I don't know why the data is so different, like on Zillow and Redfin. But look at, guys, Montana is sitting at a loss. Where's you know what? This brings me to the Dan Frio. So you know what Dan Frio, that dude that came on here, huffing and puffing. That dude says rent's going to go up another 10% this year. Not in Montana, Oklahoma, Oregon, Washington, Idaho, Nevada, Utah, Florida, Pennsylvania, or Virginia. You guys look at Montana. Montana's down 15.5% in asking rent. Holy smokes. That's huge. Is anyone hearing me on this? Does anyone see what I'm saying here? This is huge. This is huge because why is this important? First of all, I'm going to explain, okay? Why is this important? The reason this is important is because our freaking housing market has been institutionalized. So the real problem here is the capitalism in the housing market, in my opinion. And really a solution, in my opinion, as far as a government level, first of all, they'll mess it up. But they're missing home. We don't need lower interest rates. We need lower prices, and we need less demand from institutions, from investors. You guys, they're scooping up so many houses from us. It's absolutely ridiculous. So the rent going down helps us because it continues to crush investor demand. And investors right now, they own a lot of houses. So anyways, number one, Montana, 15.5% decline. Oklahoma, this is asking rent, 10.6. Oregon, double digits. Did y'all know Oregon? This is the state. This is the entire state. This is really big. This is big. Washington's 8, Idaho 7.8. Look at those are a lot of West Coast. Nevada 5.7, Utah 5.7. There's Florida at 5.5, Pennsylvania 4.5, Virginia at 3%. Maybe also the asking rents going down because the COVID bailout programs are ending. When did they end, guys? I think they ended this year. Didn't they end this year, or was it the end of last year? And look what's going on, especially Pennsylvania. Look at that. That's big, you guys. It's going to take some time because that's the asking rent, obviously, but that's pretty big. At least in my opinion, that's really, really big. All right, guys, let's see here. I was going to do one more video, but I'm going to skip this video and I'm going to go into like do some Q&As because we're already at 55 minutes. So I want to give you guys a quick update on my home buyers course. Just people keep misunderstanding what I'm talking about when I say I made a home buyers course. First of all, it's free. Okay. My thank you for helping me grow as an individual and content creator. But I'm also saying it's not time to buy. I'm not making this course because it's time to buy. I'm making this course because as we sit on the sidelines, we should learn how to buy. And I have finished the first chapter. I have released that to my course. To my channel members. I'm going to release the first chapter maybe today or tomorrow. I released it to my channel members because they reviewed it. There was one video I have to edit, and then there's a sentence I have to restructure. So it's almost done for chapter 1 release. And the first chapter is boring. It's about credit, income, assets, and mortgage. But it's really, really important stuff if you guys want to buy a house and don't want to get taken advantage of. So the whole point of the course is to not have to rely on people. So if you are a channel member, it's 99 cents. You don't have to. This is going to be out to you guys soon, to the public. But this is where it is right here. Basically, I still don't know how to use Teachable too well, but it's right here. You guys, I don't know why can't I click this link? That's messed up. I don't know why I can't click that link, but I can't click that link. Anyways, it's there, you guys. I'll have that to you soon. I'm really, really happy about that because I wanted to show you guys I don't want to just make money off of you. I want to actually help people. And now if I can afford to stay here helping people, even better, then I could do something that I love. All right, let's do some Q&As, you guys. I'm going to do some Q&As. I'll put a timestamp on our Q&As today. Some good stuff here, starting with my man, Mark. Hey, Mark, nice to see you, brother. I know you've been here from the beginning. Always love seeing you guys from the beginning. Hey, Travis, do you think we're getting to the top of the rate hike? Do you think it could get to 11%, like I said a year ago? So now, Mark, I remember I was on one of Todd Sachs' live shows, and he was like, Travis, where do you think rates are going to go? And I was like, I can see 8%, but it's hard for me to see 9%. Like, that's hard because I understand how high prices are. But there's going to be some people that see 9% right now. So, Mark, the only way that I see mortgage rates going to 10 and 11% is if outside factors gut the 10-year. If some outside factors gut the 10-year, or the Federal Reserve starts selling mortgage-backed securities at an unprecedented rate, I can see that. But overall, I don't think that we're going to hit 10 and 11%. I don't think so. We could. If we do all the better, it'll speed things up. But I personally, I don't think so. I think that as far as the federal funds rate, I think we're near the end of that. I think it ends this year. It depends on what inflation data comes, but I think it's done. I think we're going to be near the height at the rates. But I also want you guys to pay attention. Like, they haven't been raising the federal funds rate, but yet that 10-year has been skyrocketing. So the Federal Reserve, even if the Federal Reserve stops increasing their discount rate or federal funds rate, it still doesn't mean mortgage rates are going to go down. In fact, that mortgage rates can continue to go up. We see that happening right now. Good question, Mark. And I don't have all the answers. I'm just giving you my opinion, of course. Where were you yesterday? Was bonkers. I almost made it yesterday, you guys. So the thing is, man, I mean, I'm overwhelmed. Because I want to give you guys a meal every single morning. And honestly, you guys, because this content creation is new to me, some mornings I wake up and I feel like I can't even get out of bed. I won't even lie. I got so much pressure on my shoulders. I want to be so forthcoming, so transparent. I want to give you guys so much relevant information. The pressure is overwhelming. And yesterday I didn't make it because it's just the pressure. Because I've been staying up. I mean, you guys, I've been doing so much videos in the home buying course and just figuring out how to lead and help people. It's super heavy. So sorry I wasn't there yesterday. All right. So Kensley, should we be concerned that when the housing market does crash and prices decrease, that all those waiting on the sidelines will result in a massive influx and new bid wars? So I would say you need to be worried about yourself. But the thing is it depends how much, this is my opinion, it depends how much time goes on. So for example, if they dropped rates right now and say mortgage rates went to 5%, we're dead, right? I don't think enough time has gone on. And I don't think the consumer is weak enough not to make the problem worse. I think if we lower rates, consumers are not going to care and they're just going to make the problem worse. So I think right now it would be a problem. But the longer that we stay here, the less of a problem it's going to be. right? And the higher unemployment, the more corporate bankruptcies, it's going to be less of a problem. Throw in a tax to institutional investors. Maybe that will help. Okay. So here's another one. Wall Street Journal article just came out on housing market sales lowest. And that's what I was telling you guys. So lowest sales in 13 years. Okay. So, and this is okay, but some people are taking victory laps. They're saying the only crash in that, remember I talked about this in the first part of the video. They're saying the only part of the housing market that's going to crash is sales. So it is crashing, sales is crashing, but that's just the second stage. Okay. Third and fourth stage were firing on all cylinders last year, but rates went down during the middle of this year. Home buying was still on the sidelines. There was enough home buying that with that dip in rates flooded back in. Fear of missing out took over. The whole emotional foolishness kind of took over. So I think what we're going to see, Hector, again, as long as we stay elevated, we're going to see the next two stages play out, which is prices and which is inventory. So from Brian, please explain regarding first-time home buyers will be crushed. And Brian, what I'm saying here, man, is for the first-time home buyer, there's just so much stacked against them. Like, because I'm a professional of 2 decades, like I see this happen all the time. And really what I usually see, Brian, like when a transaction goes sideways, is I see home buyers that come into the transaction naive and joyful. Like, you guys, we're going to start our family. We got a new job. They're just so excited. They're so happy. They're in this honeymoon phase. Not everyone, but most people are in this honeymoon phase. And because they're so emotional, they're looking at the granite, they're looking at the countertops, they're looking, oh my gosh, there's only 5 miles from my office. People stop talking, like the professionals, the realtors, stop talking about what's important. PE, okay, price to earnings ratio, affordability, equity run-up, sustainability, wedge, cash flow. None of that is discussed with first-time homeowners. Most of the things that are discussed with first-time homeowners is, you better be pre-qualified or I'm not going to show you a house. That's typical conversation of realtor to a buyer. You better make sure you're qualified and you have that letter or I'm not going to show you. It's like, and the other problem, Brian, is like, this is one of the largest financial transactions, yet it is one of the least known about transactions. I mean, you know, first-time home buyers they're just in bad shape. And the problem is we don't learn this in elementary school. We don't learn this in high school. Most people don't know how credit works. Most people don't know how income works. Most people don't understand you can shop a mortgage. Most people don't understand so many things in real estate. So they are stuck at the mercy of a random agent. And some agents are spectacular, Brian, but most are not. And that's why I keep trying to tell you guys, empower yourself so you don't have to roll the dice. Don't be rolling the dice with the biggest financial transaction of your life. You should treat it like the biggest financial transaction of your life and only use the best professionals. Why wouldn't you want to use the best professionals? That's in a nutshell, Brian. I can keep rambling on. Tax and insurance are what an old retired guy like myself keeps an eye on. I'm about to dust off the old resume for real, though. Costs are nuts. And the reason I'm bringing this one up, guys, is because we know that there's a huge difference in home buyers right now. Basically, if you're purchasing after 2022, you're in an entirely different world, right? But to the other people, like, what is it? Maybe it's like 85% now of all of the other homeowners. Maybe it's more than that. 85% of them, you know, maybe they have the low rates and the high equity. But don't forget, you guys, those homeowners that are in the good shape with equity and low rates, they're still suffering like crazy as a result of the property taxes going up and insurance going up, especially in places like Florida. So I'm sorry to hear that, Jackson, and I'm happy to hear that. Hopefully you want to get out. Hopefully you want to get out and make a little bit more money, and you're not forced to, brother. But you know, for people on fixed income, this stuff is real bad because the government doesn't increase your Social Security income at the rate of inflation. Really sad. This is from BRN. Very good comments, BRN. I saw some real good comments from you today. I'm only bringing up a couple. Can't refinance without equity. You guys know that, right? People should be sued for lying to the first-time home buyers who are naive, ignorant about what it will take for them to be able to refinance. I agree. Now, and that's why I'm saying with that Dan Frio creep, I'm telling you guys, that guy is such a weirdo, man. He's all over the place. He's all over my page. He's upset because his lead generating business is dying, as it should. People are starting to understand these people were lying to them the whole time. But the thing is, at the end of the day, it is up to the consumer to make their mind up. So it does start at the consumer, right? And that's why, again, I'm making home buying courses instead of doing videos on how to report Dan Frio to the CFPB, because I care about you, not them, right? It starts with the empowerment. So it is what it is, guys. I'm trying the best I can to explain what goes on behind the scenes and give you stuff like that. I already talked about straight drive. Straight drive. Come with your good debates. So sometimes straight drive does have some good points. But the whole like having 9 different troll accounts, bro, it freaks me out, man. I won't lie, man. It disturbs me. I don't know why you do that. It makes me feel gross. Anyways, here's a comment from RNT. It's not people not being in the office. It's the debt they all have to refinance this year and next. Yes. RNT is talking about the commercial real estate meltdown, but RNT, it's like a quadruple whammy because it has to do with all of those things, man. They are forced to refinance. The prices are down and there's credit tightening, right? It's crazy what's happening, you guys. Here's my buddy Omaha. Sorry if I rubbed you the wrong way the other day, man. I didn't mean to do that. I thought you were being a smart addict a little bit. I won't lie. I thought you were, so I acted that way. If someone lives in truly unaffordable market like Southern California, prices could drop 30% and the average person would still be priced out of the market. This is what I say all the time, you guys. That's why I say we're talking about prices. We're not talking about, depends on what we're talking about, but affordability and prices are 2 separate things. Price has to do with affordability. But I make this comment all the time, Omaha, like if Hollywood, California dropped 70%, I personally still can't afford it. And that's why we have to empower ourselves. And that's my second chapter of my home buyers class, actually. Okay, I got Jason. I firmly believe that the Fed and government uses rates to manipulate our behavior into asset classes that most benefit keeping the music going for them. They do. So they are manipulating us, or they wouldn't be raising interest rates. The whole thing is a manipulation, guys. The whole thing is. So let me see. I think that's going to do it. I think I just wanted to say real quick before I go, appreciate you, Night Crease. So nice to see you. Just everyone there. Christy, Sean, Wendy, Hector, BRN, Luke, Sacred. You guys, Melissa, you guys, you better watch out for Melissa. She don't want to become a realtor. I want you guys to show love whenever you see Melissa. All right. Melissa, I'm worried about you. I want you to stay motivated. I know things are hard right now, but you are important. You're an important person, especially to your children. You're so important, Melissa. I don't like to hear you discouraged. Johnny, it's nice to see you. I love Johnny. Kayleen, so nice to see you. So nice to see all of you guys. Thank you so much for joining me, guys. There's my man Dooster. You guys are just such an amazing group of people. I really look forward to going through this entire cycle with you guys. You have no idea. And I'm scared. And you guys know I'm looking for a house as well. And I can't wait to share that with you. But right now, you guys, it's just, I can't find the deal of my dreams. But I'm looking every single day. Now, other than that, I'm going to come back. I'm going to have everything chaptered. I appreciate you. I love you guys. Hang in there. Make as much money as you can. Don't spend money. That's why I want to end today. Do not spend money. Cash is king. And if you're out there investing in real estate, you guys already know I wish you luck. Happy Thursday, and I hope you win.